So now that 1 year has passed since the launch of hhis and many of the underlying single stock ETFs, it's time for another full detailed review. I've also built a new dashboard for analysis and to hopefully be able to spot emerging trends or differences in performances in these ETFs. A lot of time goes into the analysis and creation of these videos, so if you'd like to follow for more, consider subscribing for future videos and to support the channel. And without further ado, let's get into the review. To start, let's quickly go over a brief history of the Harvest High Income lineup of ETFs since their launch. Initially, Harvest actually started these in August 2024, with launching a batch of single stock ETFs that were with and without leverage. The underlying stocks included were Eli Lilly, Amazon, Microsoft, and Nvidia. So hhis didn't even exist yet at this point, but there was a growing interest in having more covered call ETFs that were tied to some of the most popular technology stocks. Then on January 16th is where we see 6 more high income shares ETFs launched, which include their all-in-one solution that we all know as hhis. At this point, hhis contained the first 4 leveraged single stock ETFs, and then the additional 5 that were launched alongside hhis. Of the 5 new ones though, only 3 of them were leveraged, with Misty and Coney being without leverage. This wouldn't last too long, as in March, they then launched the leveraged versions along with 5 additional leveraged single stock ETFs. With this, hhis now contained a total of 14 single stock ETFs, which are all finally leveraged and started to broaden the diversification a bit more overall. There are some questions that started coming up though, because with these additions, it brought hhis almost up to its self-imposed cap of 15 total holdings. What would the last spot be filled with? What happens if they launch more ETFs in the future? Would they consider replacing holdings in order to achieve a higher yield? We would soon find out in June that the last spot would be going to Apple, which actually then finally completes the Magnificent 7 exposure in hhis. Now, the questions are all solely focused on what happens to hhis with the next batch of ETFs. At this point, there were many differing opinions with the direction. After the April tariff scare, hhis recovered very well and was outperforming the Nasdaq index, so there wasn't a need to change what was already working. On the other hand, some wanted to see a higher yield, and would welcome the addition of more higher volatile stocks. I've outlined the two sides in a previous video, which you can watch afterwards if you're interested. Well, the answer would come with the release of the next set of single stock ETFs in October, where we see 4 more being added to the lineup. Along with this, Harvest also made an announcement on the change of strategy to hhis, where they would be removing the cap of 15 holdings in the portfolio. By doing this, it paved the way for potential increases to the distribution of hhis, which we saw shortly after, where it was increased from 25 cents to 26 cents, and then again from 26 cents to 27 cents, where it sits today. And as we turn the calendar into 2026, Harvest continued to add to the lineup by releasing 6 more additional single stock ETFs last month. This now brings the total number of single stock ETFs to 25, but of which only CrowdStrike seems to only have made the cut to be added to hhis. So that brings us to today, 1 year and 1 month after its inception. hhis now has a total of 20 holdings. Next, let's look at the performance and some of the numbers of these ETFs. So first things first, as a member of my Patreon, you'll get access to the sheets you see in this video, along with various other sector-specific dashboards. If you're interested, you can find a link below in the description to find out more. Now if you own hhis, I'm sure that you probably noticed a steep drop in its performance lately. This has likely been due to a rotation out of technology due to the worries about AI spending, and also crypto in general, with Bitcoin taking a steep nosedive. So that is why you'll see on the chart here, where we have the total return year-to-date comparisons, that everything is literally in the red, including the indexes in VFV and VSP. The only one in the green here is Costco, and that is due to the rotation as mentioned earlier, into other more defensive sectors of the market. So unfortunately, it's not a great time to be doing a review on something that is so tech and crypto focused like hhis. But I feel like there's still a strong interest in hhis, and there are some interesting points that can be seen in its performance lately. With that in mind, I would approach the comparisons I'm about to go through a bit more objectively, and stick to how these have all performed relative to the underlying stocks instead. Because at the end of the day, the total return comparisons are what matter the most when it comes to investing in these products. So looking at the chart, we can start with hhis, where it is currently down negative 12.17% year to date. Compared to the S&P 500 index, it is down much more because of its leverage and concentration of underlying holdings in tech and crypto. Then the rest of these on the right of hhis will be all the underlying holdings within its basket, which has led to its performance year to date. The best performing one out of these is pretty clear, and is the only one in the green, which is Costco. As for the worst performing ones, they would be Reddit, Robinhood, Coinbase, Palantir, SoFi, and Circle, all of which have dropped around 25% or more so far year to date. For this chart, the only one that would be slightly inaccurate year to date so far would be CrowdStrike, and that's because it was launched on January 15th and was not available at the very beginning of the year. Moving on to the chart on the right, we see the 52-week high and low chart. With many of these now nearing the 1 year mark since inception, the bars are reflecting more accurately now since the last video. But there's also one major thing you need to keep in mind when it comes to understanding when a covered call ETF is at a supposed discount. Because there are distributions that are paid every month in this case, there is a natural drift lower in the price that happens over time. What this means is that even though these were all launched at $12 a year ago, it doesn't mean that because they're now at $12 again, it is considered cheap. This is incorrect thinking and doesn't apply to these types of income products, because you're ignoring the past 12 months of distributions that have also been paid out. So, if the price of a stock is at $12 now, and in the past year has paid out $1 in distributions, you're in reality actually buying it at $13 and not $12 when you add the distributions back. There are also the rebalancing and changes that have happened in hhis's case, where the underlying stocks are no longer the same as 1 year ago. So there's a lot of factors that go into understanding how these products work, and hopefully this explanation has helped a bit. With that said, there's still a lot more to get through, so we'll quickly move on to the next part of the analysis. So if you watched my previous video, you'll have an idea of how this dashboard works, but I'll just give a quick refresher for those who are new. The first section are all the underlying stocks of each individual high income shares ETF within hhis. Then, the section below it are all the individual high income shares ETFs themselves. All these comparisons are going to be from the inception of each individual high income shares ETF, or what is the earliest available date from Google Finance. Below this will be the ticker symbols, current price, and then the current day's change in price. After that are all the dividends or distributions that have been received since the starting date. Then lastly, and most importantly, are the total return values, which are what we'll be using to compare the individual performances. And again, this is just another reminder that all these values are based on a single one-time lump sum investment, so your own individual returns may vary, depending on when you invested or reinvested over time. Here, I'm not going to go over all 20 of these individually, because there will be another spreadsheet where I'll do so later. But since their inception dates, we have Amazon, which has outperformed its underlying by 4.39%. And then, if we scroll over to the right, we have Broadcom and Apple being the ones which have also outperformed their underlying stocks. All of the others here will have varying degrees of performance, where some are only underperforming by a few percentage points, and then others where the underperformance would be much greater. When it comes to hhis, it's not directly comparable to the Nasdaq index, but here we'll be using it just as a frame of reference. But since its inception, it's now down by 2.20% when compared to the index. This was actually not the case at the start of the year, where it was ahead by 6.86%. Now this goes for not just hhis, but also all the other ETFs above as well, and that's where the additional 25% can work both ways. And with the rotation out of technology and crypto in this past month, it has negatively impacted the total returns. This is not to say though that these will all outperform when the market starts to move back higher again. What the use of 25% leverage helps with is for the cover call strategy to perform closely to its underlying stocks. Because in general, when it comes to these products, you should be aware that there is typically a trade-off for the income, in the form of some total returns. As the product suite is called the high income shares, it is expected for them to be focused slightly more on the income as the name implies. But as Harvest's cover call strategy typically rates on approximately 33 to 35% of the holdings, you'll still have exposure to 65% to 67% of the underlying stock movements. So while yes, these products are intended to generate income, a majority will still be invested in the underlying stocks. This means, like traditional single stock investments, your timing when investing in these ETFs matter a great deal for your total returns. And an example to showcase this best is if I were to change the start dates from their inception date to April 8th of last year. This specific date was a record-breaking day in the markets, and marked a bottom as Trump announced a pause in tariffs. It was generally expected that all these covered call ETFs would get capped and underperform, but this was actually not the case. If you happened to purchase all the available single stock ETFs on this date, you would have outperformed on 9 out of 14 of them. When it comes to hhis, you would have outperformed the index by 10.70%. So again, it goes to show that timing can matter a lot, and why each person's return can vary greatly depending on your purchases. And to help with identifying discrepancies or trends, I actually created a new spreadsheet for comparing these ETFs in a bit more detail. Right now, this is just built for comparing the high income shares ETFs, but this could also be repurposed for comparing other covered call ETFs to each other in the future. So if you're a Patreon member, this might be something that comes soon as a community spreadsheet for you to use in the near future. There's not a whole lot to say for many of these, as they all follow fairly closely to their underlying stocks for the most part. Also, there are 20 individual single stock ETFs here, so there will be a lot to go through for each one. So instead, I'll just quickly cycle through them, and you can pause on the specific ones you would be most interested in. And as I go through these, there's actually one comparison at the end that I will take a closer look at, and that is for hhis. Because while it's not directly comparable to the Nasdaq index, it did hold a significant outperformance last year. And when looking at the data, hhis's decline may have actually started much further back than the rotation in the past month. As we know from earlier on in the video, hhis has gone through a lot of changes in just 1 year, where newer ETFs were added over time. One of these instances that line up timing-wise would be the inclusion of Circle, Reddit, Robinhood, and SoFi. These 4 are highly volatile stocks, which is why they have some of the highest yields out of the entire lineup. And I think it could be a reason why hhis has seen such a steep decline in its performance lately. This set of ETFs were all launched at the start of October, but they likely were not officially added into hhis until closer to the end of the month, or at the start of November. We can see by the trend between 6 months and 3 months is where we start to see a possible acceleration in the total returns decline. If I pull up hhis on Google, you can see that was a peak before it dropped 26.40% to where it is today. Of course, this is just a price return, and doesn't include the distributions that were paid out. But if I bring back up the dashboard showing the total returns since inception, we can see that these 4 have all seen quite significant declines. Circle has dropped negative 55.21%, Reddit has dropped negative 28.56%, Robinhood has dropped negative 48.44%, and SoFi has dropped negative 24.88%. When looking at their allocations within hhis, they individually might not make up a significant portion of the holdings, but together they do account for 8.70% of the portfolio. So while I can't say they are the sole reason for the decline, they haven't exactly helped either during this time. I know it may come across as a bit negative on these additions, but just as it has dropped significantly, the opposite could also happen, where they could eventually recover and rise up much more significantly. Companies like Circle and Reddit only IPO'd within the last 2 years, while Robinhood and SoFi had their IPOs in 2021. So all these companies are just starting to enter into their respective new phases of growth ahead. But right now, this is just how things look. Remember that while technology and crypto have sold off this past month, this won't be the case forever. If you believe in the long-term outlook and still like the basket of stocks, it could potentially be a good time to start a position, or consider if something like hhis would fit within your portfolio. Again, if you enjoy this comparison and analysis, consider subscribing for future videos and to support the channel. A link will be in the description if you're interested in joining the Patreon and getting access to these spreadsheets. And with that, thanks for watching, and I'll see you in the next video.